This is Matthew Cratter from Bitcoin University. You'll have to excuse my head cold today, but I have some really good news for Bitcoiners. I'm calling this more rocket fuel for Bitcoin, and we're going to be talking about the FASB updated accounting rules for Bitcoin. We've been saying for many years now the institutions are coming for Bitcoin, and now there are two options available. If you're a large corporation that wants to get exposure to Bitcoin through an ETF, no problem. In a few months from now, we're going to have the BlackRock ETF and probably a few other ETFs as well, a spot ETF finally for Bitcoin. But if you're a large corporation that wants to get exposure to Bitcoin itself by putting the actual digital asset on your balance sheet, I have good news for you as well today. And it's good news for all Bitcoiners because what it does inevitably mean, obviously, is number go up. Under these new accounting rules, these accounting rules will now help a company rather than hurting a company. For those of you who don't know, FASB just stands for Financial Accounting Standards Board. This is the designated organization that the SEC, the Securities and Exchange Commission, looks to in the U.S. for providing and setting accounting standards for publicly traded companies. So that's FASB, and the rules that they promulgate are often called Generally Accepted Accounting Principles, or GAAP. You may have heard about GAAP accounting. And so what we're talking about in this video is a change to GAAP accounting for Bitcoin and the way it's treated on balance sheets. I'll link to this article in the description notes below where I'm taking this from. This is from the Bloomberg tax section. But in order to be able to appreciate this, we have to take a look at the old way of doing Bitcoin accounting back before this change, when Bitcoin was still treated as an intangible asset. Most intangible assets are things like trademarks, patents, copyrights, goodwill, these sort of things. But for some reason, Bitcoin was put into this category initially by FASB, which was a big mistake. And it was a big mistake because it led to some very weird unintended consequences. So let's say, for example, that MicroStrategy bought some BTC at 36,000, and then Bitcoin immediately traded down to 16,000 by the quarter end. What MicroStrategy, under the old rules, needed to do was then to report an impairment of their position of $20,000 per coin, 36,000 down to 16,000. And so what you have there is a paper loss, even though the Bitcoin has not been sold. That paper loss then flows through to the earnings statement and makes it look like MicroStrategy is hemorrhaging money. And then you get lots of nasty headlines, lots of nasty articles that then Michael Saylor and the new CEO and the CFO and all these people have to deal with. And if you're an investor, if you're a hedge fund that's invested in MicroStrategy, you're probably fielding calls from your investors as well, saying, why are you invested in a company that just reported an impairment charge of over $1 billion? And of course, nothing changed, just the price of Bitcoin changed. And so this was another reason that corporations were a bit loath to hold Bitcoin on their balance sheet. But it's even worse than that under these old accounting rules, because then if Bitcoin rallied back up from 16,000 back up to 26,000, MicroStrategy under the old rules would not get to write back up the value of the BTC on its balance sheet or receive a positive boost to earnings. It gets a negative boost to earnings when Bitcoin goes down, but when Bitcoin goes up, it does not get that back unless it sells the Bitcoin. And obviously, Michael Saylor and MicroStrategy are too smart to want to sell their Bitcoin. So this sort of accounting, as we said, it makes some sense for traditional intangible assets like copyrights, trademarks, or brands that don't trade 24/7, but it really made zero sense for a liquid asset like BTC that actually trades more frequently and with more liquidity than most stocks or bonds. BTC trades over the weekend, for example, while stocks and bonds do not. So what has happened in this news release is that FASB, the Financial Accounting Standards Board, has now finally changed the rules so that investors can get better insight into a company's financial position by simply glancing at their balance sheet without having to manually make a lot of adjustments when they're analyzing the balance sheet. And this is what's called fair value accounting, this new method. And what's going to happen under this new method is a company that owns Bitcoin will simply take a snapshot of Bitcoin's price at the end of every quarter. They'll have to use an exchange traded price, so Kraken's final price or Coinbase or something for the month. And then they'll use that to calculate the value of the Bitcoin on their balance sheet, just like they would do, for example, how Warren Buffett calculates the value of Coke at the end of the quarter because he holds Coke as a corporate treasury asset. And so Bitcoin's going to be treated in a very similar way under fair value accounting rather than as an intangible asset. These new accounting rules will be mandatory for all public companies and as well as private companies that are planning to go public starting the 15th of November in 2024, which means if you have a calendar year 2025, you'll start to account for Bitcoin on your balance sheet this way in 2025. But it sounds like companies will also be able to put these new accounting rules into effect sooner, in other words, right away, if they work closely with FASB and the SEC and they make the necessary disclosures. And I don't have any inside information in this, but this is something I would expect MicroStrategy to want to do very soon and not wait till 2025. Now, why is this rocket fuel for Bitcoin? Because not only will companies soon have a Bitcoin spot ETF they can buy, but they're also going to be able to add Bitcoin, the digital asset, to their balance sheets without having to endure all those media impairment headlines and having to make endless explanations to investors. So this will mean much more widespread adoption of BTC as a legitimate store of value on company balance sheets, rather than something stupid like treasuries. So everyone was buying, all these corporations like Silicon Valley Bank, for example, they're buying treasuries for their balance sheets in 2020 and 2021. They actually believed the Fed when the Fed said they would not raise rates for a very long time. The Fed lied to them. A lot of these companies blew up. Saylor was actually one of the smart ones buying BTC for his balance sheet and his corporate balance sheet instead of U.S. Treasuries. But now this opens the door to many more companies doing this. And people begin to realize that U.S. Treasuries are not a good reserve asset for your treasury, for your corporate balance sheet. But Bitcoin is the ultimate treasury reserve asset. And it's now available to everyone under these much more fair accounting rules. Michael Saylor was the pioneer here, and he'll be remembered for that in history. But I would expect every single S&P 500 company and all the NASDAQ companies, the QQQ companies, for example, to be holding some BTC on their corporate balance sheets by 2030 or sooner. What we're really seeing here is the beginnings of a mad rush into Bitcoin that's going to take place over the next couple of years. If you enjoyed this video, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video, and let me know your questions and comments in the comment section below. Again, thanks for putting up with my head cold voice, and I'll see you in the next video.